Hey everyone, this is Intro to Options Part 2. We're going to be talking about puts, and puts are the opposite of calls. So if you have not watched the Part 1 already, that's where we cover calls and really get the basics down of options. So if you haven't watched that yet, go ahead and do that first before watching this video. And by the end of this video, you'll understand puts, and you'll understand the chart to the right, so you'll be able to read this clearly. So let's get started. Puts, it's the opposite of the call option. Puts, you have the right to sell 100 shares at a certain price by a certain date in the future. All right, so this is the opposite of a call option. Instead of wanting the market to go up, you actually want it to go down. So let's look at an example. AMC is at $1.20 per share. Okay, we'll plot that on our graph over here, $1.20 per share. I think AMC is going to go down, and I want to profit from that. So what you could do is buy an AMC put at a strike of $3. Okay, so if I'm buying a put, I have the right to sell at $3. And think about this. This is already in the money. If AMC is at $1.20, which is here, and then my strike price is up here, I have the right to sell it at $3. This is considered in the money, because if I could buy at $1.20 and then sell at $3, then that would just be like unlimited profit. I could just do that over and over again. So this would be an in the money option. And obviously that would be a great thing. I would have to be able to pay. I would have to pay to be able to sell at $3 if the stock is only at $1.20 today. So let's assume I would have to pay $1.90 to sell it at $3. Then how far down does the AMC stock have to go for us to at least break even or be in the profit? Okay, so the shares are at $1.20. Our strike price is at $3, so I can sell it at $3. And I'm paying $1.90. So this is what the math would look like. We'll take our strike price, then we'll subtract the $1.90 out of that, and we get $1.10. So we'll put our $1.10 up here, and this is where we would break even. Anything below this $1.10, that's profit. So we have the right to sell it at $3, but we paid $1.90, so our break even's at $1.10. Maybe it's better to imagine it in the reverse. So instead of subtracting, just add. So if I have $1.10, and then I add, if I paid $1.90, then it adds up to $3. So whichever way is better for you to understand. But that's the math. You're looking at the strike price and you remove what you paid for the option, and that gets you break even. Anything below that is all profit. So if AMC is below $1.10 in 4 months, then I will profit. And I'm using 4 months just as an example. So assume over here I bought the AMC put at a strike of $3 expiring in 4 months. So that would be the time frame we're looking at. All right, so same scenario. We bought that same strike. I have the right to sell it at $3, and I have to pay for that. So we figured out what our break even was, but what is our maximum loss? What's the most money that we could lose? Well, remember, you paid $1.90, and any option buyer, the most that they can lose is what they paid up front. So the maximum loss here is $1.90. So we can plot that on our chart. On the y-axis, negative 190, and that's our maximum loss. And you see, once it gets up to our strike price, that's where it flattens out. So even if AMC continues to go up, we're not going to lose any more than what we paid of that $1.90 up front. Let's look at another example. Let's say NVIDIA is at $190. I'm the put option buyer. I want NVIDIA to go down. So I buy a put at a strike of 200 for $11, expiring in 1 week. So much less time than the previous example. Before we were looking at 4 months. Now it's just 1 week. So we only have 1 week for NVIDIA to do what we want. We paid $11 for it, and this is an in the money option. It's because we're able to sell it for 200, but we could buy it for 190. So in that scenario, we would be in the money. We have to pay for that. Right? We can't just buy it at 190 and sell it at 200 and do that over and over again. So whatever we pay for it has to be greater than that $10 difference. which was the $11 that we paid for it. So in NVIDIA, it does what we want. It goes down. It went down a lot, actually. It went down to 170 in a week. So the put buyer, they exercise the put option. And exercise means that they take action on it. So they don't just let it expire worthless. They don't just let the week go by and they do nothing. They exercise the put near the end of the week. And this allows them to sell 100 shares at $200 each. So the math, they paid $11 up front for the right to do this. And they made $30 from the difference. So they were able to buy it for $170 in the market. And then they were able to sell each share at $200 based on their right from the option contract. The difference there is $19 per share. And each contract has 100 shares. So it's actually $1,900. Let's look at the other side of that trade. For every buyer, there's a seller. So the seller sold a put at a strike of $200 for $11, expiring in 1 week. So they received that credit of $11 up front, and they're hoping that the option either does nothing or it goes up. So NVIDIA drops to 170 in a week, same scenario. So they wanted the stock to go up, but instead it went down. And the buyer, the put option buyer, exercised. So that means the put seller is assigned. We are forced to receive the shares that the put buyer is wanting to sell. So we are having to buy 100 shares at $200 each. So looking at the math, we had received a credit of $11 up front. But the problem is the stock went down when we wanted it to go up. We have to buy these shares from the put buyer at $200 each. But then NVIDIA, the price is only $170. So if we buy them at $200, we turn around and sell it in the market at $170, then we would lose $30 per share. And just a side note, once you actually buy these shares, you don't have to sell it. But at the time of this contract, this is just what the math would look like. So you received a credit up front. You lost $30 from buying the shares at $200 and selling them at $170 if you decide. And that turns out to be a loss of $19 per share. So notice the profit from the put buyer is the inverse of the loss from the put seller. Let's look at scenario 2. So we're a put buyer. We want the shares to go down. NVIDIA rises to $210 in a week. So they exercise the put and they sell 100 shares at $200 each. Now, we're going to explain why this is not the best thing to do. Exercising is not always the best thing to do. Looking at the math here, okay, they lose $11 from buying the option up front. They exercise the option, which means they want to sell the shares at the strike price. So they're selling shares at $200, and to do so, they had to go into the market and buy shares at the market price of $210. So they have their contract. They have to sell the shares at $200. So they're buying shares at $210 in the market, and they're turning around and selling them for $200. That's a $10 loss. So minus $10. You add those up, and you get a $21 loss per share. So now let's look at why exercising is not the best thing to do in this scenario. The put buyer, they're better off letting the option expire worthless. So remember, just because you buy the option does not mean you have to exercise it. You can actually just do nothing, and that's called expiring worthless. So the maximum loss is the price that the buyer paid, and this is definitely something that you need to remember, because there will be scenarios like this where your profit or loss could actually be a big difference based on the decisions you make. So if you just let the option expire worthless, your loss is only your premium. It's only what you paid for the option, so $11 per share. So this person is better off because they did not exercise. They let it expire worthless, and they did not actually go through the process of having to buy the shares at $210 to turn around and sell it at $200. They did not take on they did not action that. Remember, this person never had the obligation to go through this process. They only had the right. So that's a really important thing to remember about options. Okay, let's look at the seller in this scenario. And it's going to be the same. So the put buyer exercised their put option. Okay, so the put option seller, they sold a put at a strike of $200 for $11 expiring in 1 week. So they received an $11 credit up front, and basically they have 1 week for this option to play out. And they're a put seller, so they want the share price to go up. Nvidia rises to 210 in a week, so this is what they wanted. They wanted the share price to go up. And they say, oh, well, the put is exercised, and now we're being assigned 100 shares at $200 each. So we're having to buy these shares from the put seller. So we're buying the shares at $200 each, but the market price is $210. So this would actually be kind of an odd situation for the put seller, because the put buyer would not normally exercise in this situation. Remember, we had just shown that they would normally just take an $11 loss instead of going through all this process. But here we are, the put seller. So the seller is saying, okay, yeah, sure, that's okay. I'm fine with being forced to buy it at 200 when I can immediately turn around and sell it at 210. So I'm making $10 profit per share. So the put seller says, wow, this is a rare situation, but this is great. I received an $11 credit up front, and now I'm getting an extra $10 per share just as a bonus, just because the put buyer made a mistake. Turns out to be $21 per share of profit. Now, I know I just threw a lot at you, especially if it's the first time you're looking at puts. Then just, rewatch the slides, think about the scenarios, maybe draw it out, draw the math out, or draw a graph out, and that might help you kind of digest the information that you just received. Because I'm sure if that's your first time going through it, then you're not going to fully grasp all of that. But let's recap what we went over. Put buyers want the stock to go down. And on the other side of that, put sellers want the stock to go up. Put buyers lose money if the stock stays the same or goes up. So there's really 3 scenarios. The stock goes down, stays the same, or goes up. And put buyers lose money in 2 of those. So they only make money if the stock goes down, and it has to go down enough to offset the premium they paid up front. Put sellers receive a credit up front. So the option can stay the same or go up, and they'll make money. And they're willing to take on this because they have the obligation to buy the shares from the put buyer. So they say, okay, we receive a credit up front. In 2 of the 3 scenarios, we make money. And in exchange for that, then we're obligated to buy the shares from the put buyer when the put buyer decides. So if it's expiring in a week, then the put buyer has that full week to exercise their option. Okay, this is the end of our video, and let's go through a quiz. What happens when a put seller is assigned? A, they gain the right to sell the stock at the strike price. B, they must buy the stock at the strike price. C, they receive additional premium from the buyer. Or D, the option expires worthless automatically. So put your answer down in the comments, and if you have any questions, let me know in the comments as well, and I'll answer them, and it'll probably help out other people with the same question. Okay guys, thank you for watching. In the next video, we're going to cover the difference between American and European options. And this is really critical to understand if you want to get better at options. So the next video will cover American versus European options. And it's really critical to understand this difference for someone that's trading options, because there's an important difference, and American and European options are not the same. So make sure you watch that video.